Welcome to the Deep Dive. If you've been keeping an eye on global markets, and especially digital assets, wow, this past week, it felt less like trading, more like trying to cross a highway where all the signals are malfunctioning at once. Yeah, just intense. Every headline seems to hit the screens instantly, doesn't it? Creating this really volatile atmosphere. If it demands our attention, sure, but also, a deeper understanding. So our mission today is simple. Cut through that noise. We're going to dive into the market volatility we saw this week. We'll be pulling out the key insights from a pretty comprehensive financial news analysis we've been looking at. We're going to unpack these intertwined forces. You've got rising geopolitical tensions on one side and this incredibly packed economic calendar on the other. And we'll see how they're having this immediate, profound impact on, well, digital asset values. Think of this as your shortcut, your essential guide to understanding the complex drivers behind these rapid shifts. We want to get you beyond just the headlines, give you that nuanced perspective to really make sense of it all. So yeah, let's try and navigate these turbulent waters together.
Okay, so we really have to start with the global tensions. They're not just background noise this time, are they? They feel like central players in this market drama. The analysis we're digging into makes it really clear the geopolitical stage has been, well, exceptionally active. And these events, they ripple through the markets almost instantly. It details several key things that happened just over the weekend, right before June 23rd, setting this really precarious tone. So the first big thing was a U.S. airstrike on Iranian nuclear facilities. Now, that alone is obviously significant, a direct military action, serious implications. But it escalated fast from there. Iran responded, threatening to close the Straits of Hormuz. And for our listeners, this isn't just some random waterway. It's a critical choke point.
Absolutely critical. Controls what, about a fifth of the world's daily oil?
Exactly. Closing it would instantly squeeze global energy supplies. Huge knock-on effects for oil prices, global trade, everything really.
Massive implications.
And then, as if that wasn't enough drama, Russia reportedly jumps in, stating that some countries are ready to supply Iran with nuclear weapons. I mean, just incredible timing.
The timing is remarkable, adding another layer of, well, extreme tension.
Yeah, and our source even mentioned that Kobisi letter tweet. You probably saw it. It laid out the sequence so starkly.
I did see that.
U.S. bombing, Russia's statement, Iran's parliament voting on Hormuz, all within, 72 hours.
Just boom, boom, boom.
Right. And here's where it gets really interesting and kind of puzzling, actually. Despite all this really concerning geopolitical news, stock market futures, they opened down only, a mere 0.5%.
Yeah, quite muted, wasn't it?
It really raises the question, why such a, let's say, calm reaction from traditional stocks, but these big impacts elsewhere, especially in, the digital asset space?
It's fascinating, isn't it? The divergence in those initial reactions. The Strait of Hormuz threat. I mean, that's textbook geopolitical risk. Historically, even a hint of disruption there sends oil prices jumping.
Right.
And that feeds straight into inflation worries, which then impacts central bank thinking, corporate earnings, global growth, the whole chain reaction.
So the potential fallout is huge, way beyond just the Middle East.
Exactly. But that muted stock market reaction, especially with such high-stakes stuff happening, it suggests a couple of things maybe. Perhaps traditional equity markets are just a bit, desensitized to these kinds of headlines now. Or maybe they see them as contained, isolated things that won't really hit broader profits.
Or maybe they're just slower on the uptake.
Yeah.
Waiting for more solid economic proof.
That's definitely possible, too. They often wait for more concrete economic fallout, whereas digital assets, while they trade 24/7 globally, they often have a more speculative investor base, sometimes seen as that risk-on bet or even an inflation hedge, ironically. So they tend to act as a much more immediate barometer for global uncertainty.
Like a faster-moving sensor?
Precisely. Their volatility amplifies that initial fear. You see rapid de-risking as investors look for perceived safety. So that stark difference in how they reacted really highlights the unique risk appetites and psychologies playing out across different asset classes right now.
That's a really crucial distinction. So traditional markets may be taking a wait and see, while digital assets are already pricing in a dose of fear. Okay, so on top of navigating these geopolitical minefields, the economic calendar for this week just adds another intense layer. Our source material really hammers this relentless parade of big economic data releases for the week of June 23rd to 27th. Just as impactful. A major contributor to the market's state.
It's a packed week, no doubt about it.
Let's unpack the sheer volume here. Monday, June 23rd. We already got the preliminary S&P Global Manufacturing and Services PMIs. Now, these purchasing managers' indexes, they're key leading indicators. Our audience knows this. They give you that real-time snapshot of economic activity, business mood, inflationary pressures.
Yeah, in both manufacturing and services. Really important reads.
And any big surprise in those numbers, up or down, can immediately shift market thinking on growth and, crucially, what the central banks might do next.
Absolutely.
Then Tuesday rolls around, we get existing home sales data, consumer confidence reports,
Vital signs, right? Health of the housing market, consumer willingness to spend.
both key drivers of the economy.
And on the same day, Fed Chair Jerome Powell is up before Congress. This
Okay.
isn't just routine. He's updating lawmakers on inflation, the economy.
Markets will be hanging on every word there looking for clues on interest rate policy. Always a big one.
Definitely. Then Thursday, we get updated Q1 GDP numbers. The big picture view of economic output, growth.
The broadest measure, yeah. And finally, Friday. The article flags the May Personal Consumption Expenditures, PCE, as, quote, the big report of the week.
And for good reason.
Right. Tracks inflation via consumer spending and a Fed. Well, the core PCE price index is their preferred inflation gauge, isn't it?
It is. That's the metric they watch most closely for hitting that 2% target. It directly influences policy.
And again, that Kobisi letter summary of key events this week just underlined how dense this schedule is. It's a lot for markets to digest in 5 days.
It really is.
So the question is, how does this sheer volume, the significance of these economic reports, even on their own, create volatility? And then how do they combine with the geopolitics to create what the article calls a very volatile week?
Well, that's the core of it, isn't it? Each one of those data points, PMI, consumer confidence, GDP, PCE, each one has the power to move markets individually. Like, say, if PMI comes in unexpectedly hot, that could signal sticky inflation, leading markets to price in higher rates for longer.
Okay.
Or conversely, if consumer confidence tanks, that might spark recession fears.
Got it.
Traders, algorithms, they're all poised to react instantly to surprises, to deviations from expectations. So the sheer volume this week means a constant drip feed of potential market-moving news. That's event risk around every single release.
Right. Multiple hurdles throughout the week.
Exactly. Now, layer that domestic economic uncertainty onto those rapidly escalating global tensions. We talked about Hormuz, Russia's comments.
Yeah.
And you get, well, a perfect storm scenario. Investors aren't just juggling one risk factor. They're dealing with this complex, unpredictable mix of major global and domestic forces all hitting at once.
So everything feels connected.
Profoundly. Geopolitics hits oil hits inflation data like PCE influences the Fed. Every piece of news, every headline gets scrutinized through this lens of heightened sensitivity. It amplifies the price swings, shortens reaction times, and leads to these rapid, often quite dramatic shifts in asset values. It makes navigating these markets incredibly challenging. Like, yeah, trying to forecast the weather during a hurricane, as the saying goes.
Okay, so with these dual forces churning global tensions, packed economic calendar, how exactly did the markets react? Specifically digital assets, which felt the heat pretty quickly. Let's look at the direct impact the numbers our source reported.
Yeah, let's get into the specifics.
So overall, digital assets kept weakening over that weekend, right after the U.S. action in the Middle East and the follow-on rhetoric. The total market cap lost a noticeable 4%, dropping to about $3.15 trillion.
Which is a significant chunk in a short period.
It is, although the source did mention a slight recovery starting in early Asia trading Monday morning, which I guess speaks to that immediate, almost knee-jerk reaction these markets have.
Yeah, 22047 nature again, fast moves, potential for quick bounces too.
Bitcoin, being the leader, it really led the losses initially. It dipped below six figures briefly, touching $98,500.
Oof, yeah, that's a big psychological level.
First time it went below 100K since early May. But interestingly, by the time the article was published, it had clogged back above $101,000.
So some dip buying perhaps, or just finding a bit of footing after the initial shock?
Seems like it. And Ethereum, the number 2, also took a substantial hit. It dumped over 7%, down to $2,135.
Wow, over 7%.
Yeah, its lowest point since it broke above $2,000 back in early May as well. But similar to Bitcoin, it also saw a minor recovery, trading around $2,240 on Monday morning. So you see this pattern. Sharp drop, then a bit of a rebound.
A mirrored move, which is pretty common for the top two.
And beyond those two, the article just noted most altcoins were broadly in the red. One exception mentioned was hyperliquid, but generally a sea of red.
Right, indicating it wasn't just a BTC or ETH-specific issue, it was broader market weakness driven by these macro factors.
Exactly. So connecting these price moves back to the bigger picture, what does this tell us about investor sentiment right now?
Well, I think it reveals quite a bit. The sheer speed of the reaction, big losses over a weekend, then that partial recovery, it just underscores how sensitive and, frankly, liquid these markets are. They really do act as that visible, real-time gauge for global sentiment shifts. And this wasn't just selling, it felt like a distinct de-risking impulse.
Meaning investors rushing for the exits on volatile assets.
Exactly. Moving out of assets perceived as riskier during times of extreme uncertainty. That dip below $100 K for Bitcoin, for instance, it's more than just a number. It signals a moment of pretty acute fear where even maybe long-term belief gets temporarily pushed aside by the urge to cut exposure now.
Okay.
But the fact that both Bitcoin and Ethereum reclaimed those levels, even partially, suggests that while fear was definitely present, there was also some underlying demand. Maybe bargain hunters, maybe institutions seeing a temporary dislocation. Who knows for sure?
Right. Hard to say definitively.
But the overall picture is still one of a market under significant pressure, where every piece of news, every twitch in the geopolitical or economic scene can trigger an immediate, quite pronounced response. It leads to these rapid reevaluations of risk. The market is essentially stress testing everyone's conviction in real time.
So putting it all together, synthesizing everything we've discussed, the core takeaway seems crystal clear, doesn't it? It's this powerful and increasingly tangled interplay between fast-moving global events and that super dense economic calendar. That combination is just creating an extremely volatile, really challenging environment for digital assets right now.
Couldn't agree more. The interconnectedness is key.
And for you, listening in, understanding these distinct drivers, the geopolitics, the economic data, but also how they connect and feed off each other, that's absolutely crucial. It's what lets you make sense of these wild swings you're seeing. And more importantly, it helps you build a much more informed perspective, something that goes way beyond just reacting to the latest price alert or headline.
Yeah, it's about seeing the threads.
Seeing how these seemingly separate global forces are actually linked.
Precisely. Recognizing they aren't isolated things. It's a complex web, international tensions, domestic economic health, the expectations around both. The market isn't just reacting to one trigger, but to this delicate, shifting balance. Being able to identify the individual stressors and then grasp their collective impact, that's what brings clarity in these turbulent times.
Well said. And maybe here's a final thought for you to chew on as you navigate all this. In this world that just keeps getting more interconnected, where information moves at light speed and global events can basically unfold live on our screens, how might this sheer acceleration continue to compress market reaction times and maybe amplify the swings even further?
That's a really interesting point.
Will that instantaneous awareness of everything, diverse factors, often non-financial ones, become even more critical for anyone trying to navigate these financial landscapes? Something to think about.
Definitely food for thought. How quickly information becomes priced in and what kind of information.
Exactly. Well, that's our deep dive for today. We'll see you next time.